Hey, big breaking news on Alphabet. That's the parent company of Google. They had a high bar to climb when they posted their financial results after the bell. Well, those numbers cleared those estimates with ease, sending that stock to an all-time high in after-hours trading. You can see it right there on your screen. During the session, however, equities were mixed. The S&P, Russell 2000, NASDAQ, they all edged higher. The Dow was fractionally lower. I got to tell you that I wasn't happy with the fact that only 3 sectors were higher in the S&P 500, and market breadth was negative. Those are red. Those are yellow flags for me. Meanwhile, the 10-year Treasury yield surged today, which helped financials rally higher, picking up from last week where you saw some big banks gain traction on earnings news. The S&P Financial Index is still down for the year, believe it or not, and it's been non-banks that have helped the financials higher, like TD Ameritrade, which reported a pretty strong number after the close. So the question is, can financials finally live up to Wall Street's hype, and does the fate of these big banks all of a sudden solely just depend on the Federal Reserve? James Freeman, author of Borrowed Time, 2 Centuries of Booms, Busts, and Bailouts at Citi, is back with me. I can't wait for that book. I saw a review in the Financial Times, and I'm a history buff as well, so I know I'm going to love it.
Oh, good. Thank you. Hope so.
The market, it's Google, Alphabet through the roof, but you've had 3 stocks that are responsible for like 70% of the move this year. How long can it keep going, and what other and can the financials, which were supposed to be the sort of the sector that was going to grab the rally baton? Every genius on Wall Street said the financials. When are they going to step up to the plate?
Well, look, they're performing. You look at in terms of the big banks, with the exception of Wells, great earnings reports, just like we've seen for the S&P 500 as a whole. Very high bar coming into this earnings season, but companies generally are exceeding it. Growing earnings more than 20%.
The banks, though, seem like, it's like all of a sudden, particularly these big names, right? It seems like over the years they got drunk on trading and drunk on these products or derivatives or whatever they could do, and they forgot good old-fashioned banking, right? That's why I like Bank of America's numbers, because I saw where they were lending money. I saw where the credit card stuff was going up. They were doing things that the average consumer gets benefits from. And now all I hear is that the bank's fate relies on the fact that yields have to go up and the Fed's got to raise rates. I mean, that's a tough industry to be in when your entire fate relies on what the Fed does.
Well, I think you are seeing at most of these companies kind of growth across the board, healthy loan growth, demand from consumers and from businesses. You're seeing a lot of strength because the economy's good. Their customers are doing well. Also, the banks really benefited from the tax cut, like a lot of other industries. But I think some of the concern is the general fear that's out there in the market that we're on a sugar high, that the tax cuts might have helped us this year,
right,
but long term we're kind of back to the old slow new normal. I don't believe that, and I think maybe some of these companies will get reevaluated as we see the power of the tax cuts roll out over the years.
On that point, we get the GDP number on Friday. A lot of hype out there. It could possibly even be 5%. You got to go back to 2014. We had 2 very strong quarters, but it was a terrible year. So, again, it is going to be about sustainability. You're feeling pretty confident right now that success, tariffs aside, that success begets success, and that sort of these wheels of commerce are moving pretty good right now.
I do worry about the trade stuff. We've talked about that. But I think when you're talking about making the U.S. more competitive in the world and the dramatic reduction in the corporate tax rate, pulling capital, pulling investment back into the United States, this is not a sugar high. When companies make capital expenditure decisions, and we see that ramping up, people investing more in the United States, these are long-term decisions. These are not 6-month decisions, 12-month decisions. This is about years into the future, betting on U.S. growth. And so I think the incentives will remain, and it's not a short-term phenomenon. It is a long-term game changer in terms of U.S. competitiveness.
Yeah, golly, I forgot. I had one name after the bell that just raised their CapEx 165%. From the first half, they saw the CapEx up 165%. Oh, Werner, the truckers.
Yep.
I love truckers.
Yep.
CapEx up 165% from a year ago. That is amazing stuff. And they say all the tax cuts only go to the wealthy. That represents jobs and, to your point, long-term benefits.
And higher wages.
Right.
That's what all the data around the world tells us. That's why they focused on the corporate tax cut. More investment means workers are more productive. That means they get paid more.
All right, James, thanks a lot, and congratulations
Thanks,
on the book. We'll talk about it again.